Insurance policies. This lesson covers specialized forms of life insurance that are defined not by their structure but by their purpose. Joint, first to die, life insurance. Joint life insurance insures two people, both of whom must undergo underwriting, under one policy. The policy pays the death benefit to the beneficiary, typically the surviving insured, when the first insured dies. The main appeal of this policy is cost. The premium is less than it would be for two separate policies providing the same death benefit. Joint life insurance is especially popular in two situations. Business partnerships use it to provide the funds needed for the surviving partner to buy out a deceased partner's share of the business. Young families use it to help surviving parents replace income or parental services lost through either parent's premature death. When the first insured dies under a joint life policy, the surviving insured is entitled to buy an individual policy with the same or a lesser face amount without having to prove insurability. While term life insurance is sometimes used, joint life insurance most commonly uses universal life insurance. Survivorship, second to die, life insurance. Another form of dual-insured life insurance is called survivorship life insurance because these policies pay the death benefit only upon the second insured's death. As with joint life, survivorship life premiums are lower than they would be for two comparable single life policies. Also like joint life, survivorship life requires both applicants to undergo underwriting. Survivorship life is especially popular in the estate planning market. Married couples use it to provide money needed when the surviving spouse dies, which is when estate taxes and other estate settlement costs are due. Survivorship life is available as straight whole life, universal life, variable life, and index life insurance. Because of the long-term nature of this coverage, term life insurance is not suitable for use with survivorship life. Juvenile life insurance. Life insurance can be written on children of any age, beginning at 1 day old. If the proposed insured is a minor, under age 15 for insurance in most states, a parent, grandparent, or guardian must be the policy's applicant, owner, and premium payer. A special type of whole life insurance has been created for the juvenile market. Popularly called jumping juvenile life insurance, it features low premiums and a death benefit that increases when the child becomes an adult with no increase in premium and without requiring evidence of insurability. Juvenile life policies are typically issued with a death benefit that is measured in units, where each unit represents $1,000 of death benefit. At age 21, the value of the unit jumps up to a higher value, most commonly 5 times the original value. The increase in the unit value translates into an increase in the face amount. Example: a juvenile life policy issued with 10 death benefit units, $10,000, would see its death benefit increase to $50,000 at age 21, with no increase in premium. Specialized policies for family needs. There are specialized life insurance policies that provide families with extra coverage during their childrearing years, when the need for money is especially crucial. These policies combine both whole life and term insurance into a single policy that provides a lump sum death benefit, provided by the whole life insurance, and a stream of income for a period of time following the insured's death, funded by a term life insurance rider attached to the whole life policy. Family income policies. A family income policy is a life insurance policy that combines whole life insurance and a decreasing term life insurance rider to provide both a lump sum death benefit and a stream of income to a date specified in the policy if the insured dies before that date. If the insured, typically the family's main wage earner, dies after the specified date, only the lump sum death benefit is payable. Decreasing term life is used because the potential income period decreases with each passing year. If the insured is alive at the specified date, which is typically anywhere from 5 to 20 years following policy issue, the term coverage vanishes. The whole life death benefit protection remains in place for the insured's entire life. If the insured dies prior to the specified date, in the example below, before the 20th policy year, the whole life death benefit is paid out at the end of the income period. If death occurs after the specified date, the death benefit is paid out immediately. Family maintenance policies. Like a family income policy, A family maintenance policy provides both a lump sum benefit and monthly income that is funded by a term life rider. The chief difference between the two types of coverage involves the length of time the monthly income is provided following the insured's death. If the insured dies before the specified date, the family maintenance policy maintains income for a fixed period of time from the time of death. Because a fixed period of income is provided, level term insurance is used to fund the monthly income benefit. Example: if the insured under a 20-year family income policy dies in the 5th policy year, monthly income payments will be made to the beneficiary for 15 years. If the insured dies in the 14th year, monthly income payments will be made to the beneficiary for 6 years. If the insured dies in the 21st policy year, no monthly income benefit is payable, though the whole life death benefit would be paid. If the insured under a 20-year family maintenance policy dies in the 5th year, monthly income payments will be made to the beneficiary for 20 years. Likewise, if the insured dies in the 14th year, monthly income payments will still be made to the beneficiary for 20 years. The whole life death benefit is paid immediately upon the insured's death, whenever that occurs, not at the end of the income period, as is done with a family income policy. Family protection policies. A family protection life insurance policy covers an entire family under a single policy. Slightly different variations exist, but a family policy generally provides whole life insurance coverage on the principal insured, convertible term life insurance coverage on the spouse to age 65, convertible term life insurance coverage on each child to age 21. For your review: joint life insurance covers two insureds under a single policy that pays the death benefit upon the first insured's death. It is popular with businesses and young families. Survivorship life insurance covers two insureds under a single policy that pays the death benefit upon the second insured's death. It is popular in estate planning. Juvenile life insurance has a face amount that increases to 5 times its size when the insured child reaches age 21, with no increase in premium. Family income policies use decreasing term to fund a potential income period that decreases as the policy ages. Family maintenance policies use level term insurance to maintain income for a level period of time from the time of death. Family protection policies provide whole life coverage on one parent and convertible term life coverage on the spouse and children. Please pause the audio.
When it comes to selling life insurance, there's a type of product available now for just about every need that you're going to come across. And it's important to understand these different types because you'll have customers that'll look for a specific need, and it's nice to be able to say, I have a solution for that. This lesson talks about specialized life insurance policies, those policies that are designed for specific niche markets, you might want to say. It talks about things like joint life, second to die policies. It talks about juvenile life insurance policies. That's life insurance written on a child for which an adult is the owner. They all have special needs and a special place. What I want to take a moment to talk about is the distinction between two types of policies that can be confusing, especially when you're facing a life insurance exam. And that's the difference between a family income policy and a family maintenance policy. Now, both of these policies feature the same basic construction: a whole life or a permanent life insurance policy and a term life insurance policy on the side as a rider that provides for income in the event of the insured's death. So if you will, again, the permanent life insurance policy provides a lump sum death benefit for whatever purpose the insured wants or the policy owner wants, but that term insurance rider is designed for one purpose, and that is to provide a stream of income to the survivors. So what's the difference? A family income policy is based on a decreasing term rider, whereas a family maintenance policy uses a level term rider. Now think of the difference. Decreasing term means as time goes on, there's going to be less and less money available to provide a stream of income. A family maintenance policy with a level term rider is going to provide the same amount of money whenever death occurs to provide a stream of income. Carrying that one step further, what we learn is a family income policy is issued with a date in the future that will be the ending date of income should the insured die at any point between now and that date. So, for example, if that income end date is 20 years from now, then there is a 20-year decreasing term rider attached to the policy. If the insured dies in 10 years, well, that's half the income period already gone by. There will be only 10 years remaining of income payments before the income ends. The family maintenance policy, on the other hand, has a level term rider. It will provide a stream of income, let's say for 20 years, whenever death occurs, assuming the death occurs in the next 20 years. So if the insured dies in 10 years, the survivors will get 20 years of income. If the insured dies in 19 years, guess what? The survivors will get a stream of income for 20 years. Think of it this way. A family income policy pays income to a specified date. A family maintenance policy maintains a level amount of income for a specified period of time whenever death occurs.
Okay, so here is the questions for this chapter. With a survivorship life insurance policy, the insurer pays the death benefits when the surviving spouse dies. What does a family life insurance policy offer? A life insurance policy on every family member in their single policy. And it could be this top one, I can't remember. With a joint life insurance policy, which of the following best describes the coverage continuation option available to the surviving issued upon the death of the first insured? The surviving insured may buy an individual policy with the same or lesser amount. The surviving insured may continue to exist joint life policy. The surviving insured may buy an individual policy with the same or lesser value. The surviving insured may continue this. All right, I'm going to go with the first one. I'm not sure about that one. Okay, so this one is what is wrong. Okay, because this is all the following are correct except. So which one of these is wrong? Is only paid only at the survivor's end. Premiums are about the same for two comparable life insurance. They're also known as second to die policies. I don't know what that is, so I'm going to put that is the answer. We only got one right. I'm really doing bad on these lately. All right, so survivorship life insurance policies are commonly known as second to die policies. Oh, okay. They insure more than one person, but pay the death benefit only to the second insured. All right, so that's the only one I got right. The rest of them I got wrong. So this one is, what does a family life insurance policy offer? Whole life insurance on the primary insured and term life on the spouse and each child to age 21. That was my second choice. So I should have clicked it, right? Shoulda, woulda, coulda. Go with your first instinct. This one is, with a joint life insurance policy, which of the following describes the coverage continuation option available to the surviving insured? The surviving insured may buy an individual policy with the same or lesser amount without having to provide evidence of insurability. That's the correct answer. So they can buy an individual policy with the same or lesser amount without having to provide evidence of insurability. All right, 4. The one that's wrong, the premiums are about the same as for two comparable single life policies. Survivorship life insurance policies are also known as second to die policies, so that one is correct. The premiums are about the same for two comparable single life policies is wrong. Premiums are not the same for two single life policies. Okay, thank you everybody for watching till the end if you made it. I'll see you on the next video.